In 1965, Charlie Munger's investment partnership returned 20%. The market did 10. By 1969, his cumulative return had nearly doubled the S&P. By the time he merged into Berkshire Hathaway in 1978, he'd compounded capital at over 19% annually for 14 years. He never built a fancy model. He never used a Bloomberg terminal. He read a lot. But the part that's interesting isn't that Munger read, it's how he read and what he was looking for. Because Charlie Munger's edge was never being smarter than other investors. His edge was being wrong less often. And the way he avoided being wrong is the most useful thing any thinking person has ever written down.
Poor Charlie's Almanack isn't really a book. It's a doorstop. The original hardcover is over 600 pages, weighs nearly 4 pounds, and was named after Benjamin Franklin's Poor Richard's Almanack, the 1700s collection of sayings and aphorisms that shaped American thinking. That parallel is intentional. Munger considered Franklin one of the greatest thinkers in American history, and he wrote his book to do for the 21st century what Franklin's did for the 18th. The book is structured as a collection of Munger's speeches, essays, and commentaries, assembled by his friend Peter Kaufman in 2005. Most book breakdowns of Poor Charlie's Almanack focus on the famous Psychology of Human Misjudgment section, which catalogs 25 cognitive biases. That section is excellent. It's also the smallest part of what makes Munger important. The bigger insight running through the entire book is this. Munger built his investment edge by deliberately, systematically refusing to be wrong. Most investors try to be right. Munger inverted the question. He spent his career asking, what would cause me to be catastrophically wrong here? And avoiding those situations entirely. That sounds simple. It's not. Because the human brain is wired to look for confirmation, not contradiction. Munger spent decades training his mind to do the opposite, and the toolkit he developed for doing it is what Poor Charlie's Almanack documents. Munger read Daniel Kahneman extensively. He cited Kahneman's work on cognitive bias for decades, even before Thinking Fast and Slow made those ideas mainstream. But where Kahneman described the problem of human cognition, Munger built the solution. Today's lessons are that solution. If you want the deeper version of the problem itself, our breakdown of Kahneman is available, but you don't need it to follow what's coming next. Lesson 1. Invert. Always invert. Munger borrowed this phrase from a 19th century mathematician named Carl Jacobi. The principle is simple. When a problem is hard to solve forward, solve it backward. Don't ask, how do I get rich? Ask, how do I avoid being poor? Don't ask, how do I succeed? Ask, how do I guarantee failure? And then refuse to do any of those things. Munger used inversion constantly. Picking stocks. He didn't ask which stocks would make him money. He asked which businesses would absolutely destroy his capital. Over-leveraged, undifferentiated, run by people he didn't trust, and threw those out first. What remained was a much smaller, much higher quality pool to actually evaluate. Try this with any current decision in your life. The career question becomes, what would make this career a complete waste of my time? The investing question becomes, what would cause this stock to lose 80% of its value? The relationship question becomes, what kinds of people consistently destroy their partners' lives? The answer space shrinks dramatically. The path becomes visible. Lesson 2. Build a latticework of mental models. Munger argued that you can't navigate the world with a single intellectual tool. If your only training is in finance, you'll see every problem as a finance problem. If your only training is in engineering, you'll over-engineer everything. The world is too complex for any single discipline to capture. His solution was what he called a latticework of mental models. Take the most powerful, durable ideas from many different disciplines: psychology, physics, biology, economics, history, mathematics, and use them in combination. Most problems aren't solvable by one model. They yield to several models layered together. For example, when Munger evaluated a potential investment, he might pull from biology, competitive niches, ecosystems; psychology, incentives, biases of management; physics, network effects, scaling; and economics, margin structure, capital requirements, all in one analysis. No MBA program teaches this kind of thinking. You build it yourself, one model at a time, over decades of reading and reflection. The practical implication? The best investors aren't the ones with the most finance knowledge. They're the ones with the broadest reading habits across the most disciplines. Munger called this worldly wisdom, the kind of understanding that doesn't fit in any single textbook. Lesson 3. Lollapalooza effects. Most psychological biases aren't dangerous on their own. Confirmation bias alone won't sink you. Social proof alone won't sink you. The danger is when multiple biases stack on top of each other and reinforce in the same direction. Munger called these Lollapalooza effects, and he argued they explain almost every catastrophic financial decision in history. Take any market bubble, the dot-com era, crypto in 2021, any housing bubble. None of these happened because investors made a single cognitive error. They happened because 4 or 5 errors compounded simultaneously. Social proof: everyone is buying. Authority: experts say it'll keep rising. Commitment bias: I told my friends I bought in. Loss aversion in reverse: if I sell now, I'll miss the next leg up. Recency: it's gone up for 3 years. Why would it stop? When 5 biases push you in the same direction at once, your rational brain doesn't stand a chance. That's why bubbles are so destructive, not because any individual is irrational, but because the conditions that produce bubbles activate every flaw in human cognition simultaneously. The defense is recognizing the pattern. When you notice 3 or 4 biases lining up the same direction, step back. That's not signal, that's Lollapalooza. Munger's discipline was to be most skeptical exactly when he felt most confident, because confidence is what Lollapalooza creates, right before it destroys you. Lesson 4. Stay within your circle of competence. This is one of Munger's most quoted ideas, and one of the most misunderstood. The circle of competence isn't about how much you know, it's about how clearly you know what you don't know. Munger argued that the size of your competence circle matters far less than the precision of its perimeter. A doctor who knows medicine deeply and clearly knows nothing about commodities trading is in a strong position. A trader who thinks he understands medicine because he's read a few books is in danger. The first person can find their edge. The second has no edge anywhere because they don't know where their edge stops. Most investing mistakes happen at the perimeter, when someone steps slightly outside their actual competence and assumes their general intelligence transfers. It usually doesn't. Domain expertise is incredibly specific. The CEO who's brilliant at running a software company doesn't automatically understand pharmaceutical investing. The lawyer who's a great litigator isn't a great real estate investor. Skill is local. Competence boundaries are sharp. The practical move? Write down, honestly, the 3 or 4 areas where you genuinely understand something better than 95% of people. That's your competence circle. Stay inside it. Refuse opportunities outside it, no matter how attractive they look. The opportunities you decline because they're outside your circle will save you far more than the opportunities you take inside it will earn you. Lesson 5. The psychology of human misjudgment. This is the lesson most people associate with Munger, his catalog of 25 standard psychological errors humans make. But the deeper lesson isn't the list. It's why he compiled the list.
Munger argued that almost all serious mistakes in business, investing, marriage, parenting, career come from a small number of recurring psychological patterns. If you memorize the patterns and watch for them, you eliminate most disasters before they happen. He compared it to a doctor's checklist for a complex surgery. The checklist isn't intellectual, it's preventive. A few of the most useful patterns he documented. Reward and punishment, super response, tendency. Never underestimate the power of incentives. Liking distortion. We believe and trust people we like, regardless of whether they're correct. Doubt avoidance tendency. When faced with uncertainty, the brain rushes to conclusions just to escape the discomfort. Inconsistency avoidance. Once you commit to a position, your brain fights to keep you committed even when evidence shifts. These aren't theoretical. Every disastrous decision you've ever made was driven by one or more of these. Every disastrous decision your friends have made. Every catastrophic CEO move you've read about in the Wall Street Journal. The patterns repeat. The names of the people change. Munger's contribution was naming them clearly enough that you can spot them in real time. The follow-through? Keep a personal checklist of biases near your desk. When facing a major decision, run through it. Not as an intellectual exercise, as a defensive scan. Which bias is currently active in my thinking? Inversion question. Which bias would have to be active for me to be wrong here? Identifying the bias doesn't always change the decision, but it makes the bias visible, which is the first step to diffusing it. Lesson 6. Sit on your hands. Munger's investment style was famously inactive. He said most of his career success came from doing nothing, sitting still, holding good businesses, refusing to act on noise. He called this the assiduity of a station keeper, the patience of someone whose job is mostly to wait. Most investors fail because they trade too much. They feel an obligation to do something. The market drops 5%, they sell. A stock pops 20%, they buy more. A new opportunity appears, they jump in. Each of these movements feels productive. Cumulatively, they're devastating. Transaction costs, taxes, mistakes, and emotional fatigue compound into massive underperformance. Munger's discipline was the opposite. Find a small number of excellent businesses, buy them at reasonable prices, hold them, often for decades. Berkshire's largest positions. Coca-Cola, American Express, See's Candies were purchased in the 1980s and held into the 2020s. The compound return on a simple decision held for 40 years dwarfs the return on 1,000 clever, short-term decisions. The wider application? Whatever you've decided is good. A relationship, a career, a portfolio, a discipline. Your default action should be to keep doing it. The bias toward action is almost always wrong. The bias toward continuity is almost always right. Boring is the secret to compounding. Lesson 7. Compound knowledge. The way you compound money. This is the lesson that gives this channel its tagline. Munger argued that wisdom compounds the same way capital does. Read 30 minutes a day, every day, for 30 years, and you accumulate intellectual capital that simply cannot be replicated by someone who tries to cram. The compounding is mathematical, not metaphorical. He told the story of how he spent every spare moment reading biographies, sciences, history, business cases. He once said that he'd never met anyone wise who didn't read all the time. Not occasionally, constantly. Munger read on planes, in hotel lobbies, at his kitchen table, between meetings. He treated reading the way an athlete treats training. Non-negotiable. Daily. Lifelong. The practical math? If you read for an hour every weekday, 250 hours a year, and you maintained that discipline for 20 years, you've put 5,000 hours into deep, deliberate reading. That's roughly the threshold for world-class expertise in any field.
Most people spend more than that watching television in a single year. The compounding isn't in the speed, it's in the consistency. But Munger was specific. Not all reading is equal. He had little patience for self-help, business pop fiction, or anything that didn't have intellectual durability. He wanted books that were still being read 50 years after they were written. Charles Darwin, Adam Smith, Cicero, Benjamin Franklin. The great texts that earn rereading. The lessons that compound. The ones that still pay returns decades after you first encounter them. That's the central thesis of Munger's life's work. And it's the operating principle of this channel. Pick the right books, read them carefully, return to them often, and compound the wisdom over decades. The lessons that compound. That's the bet. Poor Charlie's Almanack gets a great deal right, but it has limits. 3 honest critiques worth naming. First, the book is heavily curated. It's not Munger writing in real time, it's Peter Kaufman selecting and editing decades of Munger's speeches and commentary. That curation makes the book more readable, but it also smooths out the inconsistencies, the changing positions, the moments where Munger was wrong. The Munger of Poor Charlie's Almanack is the perfected retroactive version. The actual Munger made plenty of mistakes. He just rarely talked about them in the same speeches he later edited into the book. Second, the mental models framework can become a kind of intellectual maximalism. The implicit instruction is, learn everything from every discipline. That's not actionable for almost anyone. Munger had 70 years of obsessive reading behind him when he formulated the Latticework idea. Most readers don't have that runway. The result is that people walk away from the book feeling they should be polymaths, and that pressure can paralyze rather than enable. The honest version of the lesson is narrower. Pick a small handful of models from a small handful of disciplines, master them deeply, apply them constantly, and add new ones slowly. That's achievable. The encyclopedic version is not. Third, and this is where we'll get slightly opinionated. Poor Charlie's Almanack underestimates how much Munger's success depended on conditions that no longer exist. The post-war American economy, in which Munger and Buffett built their edge, was uniquely stable, uniquely concentrated, and uniquely permissive of long-term holds. Today's markets are faster, more efficient, and more crowded, with sophisticated investors using the same mental models Munger pioneered. The frameworks still work, but the alpha they generate has compressed dramatically. A modern reader who treats Poor Charlie's Almanack as a literal playbook for investment success is going to be disappointed. A reader who treats it as a manual for clear thinking, applicable to every decision in life, not just investing, will get tremendous value. Munger himself acknowledged this. In his later speeches, he often said the modern investing environment was harder than the one he started in, and that beating the market was now extraordinarily difficult, even for skilled professionals. The wisdom in the book remains intact. The competitive advantage of the wisdom has eroded. That's an honest read. What survives untouched is the thinking framework. Inversion, mental models, Lollapalooza effects, circle of competence, sitting on your hands, compounding knowledge. These tools work in any era, any market, any decision domain. They just don't guarantee the kind of returns Munger achieved. They guarantee something more useful, a substantial reduction in catastrophic mistakes. So here's the one thing to do today. Not tomorrow, today. Start your own checklist. 1 page. Pick 5 mental models from your domain, not Munger's domain, yours. The disciplines you actually understand, your industry, your craft, your area of professional expertise. From those, Identify the 5 most useful patterns you've noticed. Write them down. Then, for each model, write one inversion question. The question that, when asked, would have prevented the worst mistake you've made in the last 5 years. For example, if you're an operator, maybe one model is competitive moats. The inversion question becomes, what would cause this product's moat to disappear? If you're an investor, maybe one model is base rates. The inversion question becomes, what does the historical data say about businesses like this? And am I assuming this one is the exception without good reason? If you're managing people, maybe one model is incentives drive behavior. The inversion question becomes, what incentive structure am I unintentionally creating? And what behavior will it produce in 2 years? 5 mental models, 5 inversion questions, 1 page. Pin it to the wall above your desk. Read it before every major decision. This isn't a one-time exercise. The list grows over years. You add models as you read. You refine the inversion questions as you make more mistakes and learn what they should have warned you about. By year 5, your 1-page checklist will be the single most valuable document you own. That's how you actually use Munger. Not by memorizing his 25 biases or his 100 mental models. By starting your own list, small, specific, relentlessly practical, and letting it compound the way every other valuable thing in life compounds. Slowly, patiently, over decades. Charlie Munger died in 2023, weeks before his 100th birthday. He was clear-minded and reading until almost the end. His final advice to interviewers, asked dozens of times in the last decade of his life, was always some version of the same thing, and we'll preserve his exact phrasing here because the bluntness was his point. Read constantly, think clearly, and avoid being a fool. That sounds modest. It isn't. Most of the catastrophic mistakes you'll make in your life, the bad investments, the wrong career moves, the relationships that wreck you, the businesses that fail, won't come from a lack of intelligence. They'll come from being a fool in a specific, predictable way. Confirmation bias, overconfidence, social proof, Lollapalooza. The patterns are knowable. The mistakes are avoidable. But only if you train your brain to spot them in real time, every day, for the rest of your life. That's what Munger built. And that's what poor Charlie's Almanack offers anyone willing to read it carefully. Not a path to becoming the next Buffett. A path to becoming substantially less stupid than the version of yourself who started. One question worth sitting with, and we'd genuinely like to hear your answer in the comments. Which of Munger's 7 lessons do you think you're most often violating? Not the one that resonated most, the one you keep failing at. That's the one worth working on. Subscribe. We break down one great book every week. The foundational ones on money, business, and decision-making. The lessons that compound. Until then, read carefully, think clearly, and avoid being a fool.